I'll get it up in a second.
Good morning, everybody. I'm Nicky Economides. I'm an underwriter with the Beasley Group. And what we want to talk about this morning is the intersection of crime insurance and cyber insurance. As I've talked to brokers and insureds around the country, I've found that there's a lot of confusion about what a cyber policy is designed to do and what a crime policy is designed to do. So what we thought would be a good idea this morning is just to spend a few minutes and talk about primarily what the intent of a cyber policy is versus the intent of a crime policy is and where different things go. So joining me this morning, starting at this end of the table, is Scott Gaddis. Sorry, Scott. Scott Gaddis is an attorney with a lot of experienced trial attorney with Barnes and Thornburg and has a specialty in technology and insurance coverage issues. To Scott's right is John Merchant. John is head of cyber and professional liability at Freedom Specialty. To John's right is Dave Lewison. Dave is the National Financial Services co-practice leader at Amwins Brokerage Group. To Dave's right is Chris Liu, who is the cyber portfolio manager in the Financial Institutions Division of AIG Property and Casualty. And finally, at the end of the table is Bob O'Lawson, and he's a manager with specialty commercial lines at the Insurance Services Office. So, to kick things off, to give you an idea of what our presentation format's going to be, we want to start with a little discussion about the intent of coverage and then get into a couple of different scenarios and walk through them and discuss the coverage implications. So to start off, I'm going to pick on Chris. I'm going to ask Chris, have you seen any situations where, in your opinion, a policyholder has attempted to make a claim under a crime or cyber policy that was outside the intent of coverage? And can you tell us about that?
Yes. So for the most part, the most usual circumstances, we see insureds who will report cyber claims to crime policies and crime claims to cyber policies. So that's sort of why we ended up here. For the most part, we imagine that crime policies are first-party theft. So you'll see claims for fraudulent return of goods or exchanges of goods where somebody comes in and says, I bought this jacket here, they exchange it for cash. The store then realizes that it's not actually theirs, they didn't make this sale, and then they try to recoup the cost of that good under their policy. That's not covered. Some of the things we talked about already not covered under the cyber policies are reputational value loss, intellectual property value loss, and something pertinent is banks who were impacted by the Target breach, submitting that as a claim under their policy is not a covered matter.
Okay. Scott, let's pick on you. Let's take it from the other side because you're an attorney that represents policyholders seeking coverage. From your standpoint, are policyholders overreaching for coverage, or are there times when a cyber and crime policy may overlap?
Absolutely not.
I thought you'd say that.
So let me give you 4 reasons why. Retail Ventures is a case that you've probably heard about. If you've heard me speak before, you've heard me talk about it. So what was Retail Ventures? If you want inexpensive shoes, you've shopped at DSW Shoe. And Retail Ventures owns DSW Shoe. They, pardon me for my Marco Rubio moment, DSW got hacked by Alberto Gonzalez, a guy in his early 20s who went to jail for hacking and stealing millions of credit card records. Great. So for everybody who was at the PCI panel yesterday, you know that as a result of having payment card data stolen, DSW and Retail Ventures had millions of dollars taken from it to the tune of about $4 million from the payment card brands. They also had FTC investigations. They had some class actions filed against them. Retail Ventures most likely did not have a cyber insurance policy, but their lawyers were smart, and they said, okay, where can we go? We've been the victim of a crime. So they did 2 things. One, they went to their CGL carrier and said, would you please defend us against these class actions? And as we learned from the court case, the CGL carriers, contrary to what everybody tells me that they see me at these conferences, stepped up and decided to defend the actions. But then there was a lot of money that was still left at stake, about $6.8 million. So Retail Ventures goes to our friends at AIG and says, would you please cover us? And AIG said, I don't think we intended to cover this, even though there's not a specific exclusion for these types of risks. And they actually went to 2 outside law firms. And they went to one law firm that said, we think, actually, there could be coverage here. And they went to a second law firm and said, no, they missed this exclusion. There's no coverage here. And so Retail Ventures sues AIG and says, you should cover because we're the victims of a crime. We had loss as a result of it. You have a computer fraud and funds transfer fraud endorsement within your policy. You should cover. It's appropriate to do to try and seek the coverage. And if the intent is to not cover it, put an exclusion in saying data breaches need not apply here. But they didn't. So in federal court in Ohio, the judge says, okay, I agree. This should be covered. You're right. The exclusions do not apply. And the basics are that if you're within the coverage, the insurance carrier has to prove that the exclusion applies. And we don't believe that an exclusion applies here. And then there was a question of, well, was it in bad faith? Particularly because there was one opinion saying that it's actually coverable. And the court says, no, I'll give you the one free dog bite rule. You get a free pass because we're not aware of anybody else that had this issue come about. And so then they appeal. And the Sixth Circuit Court of Appeals, federal court, respected federal court, says, we agree. There is coverage for these losses. After a data privacy incident in which you've paid millions of dollars to the credit card brands, willingly or unwillingly, you've had a crime, you've had loss, and the exclusions do not apply. Great. And so is Retail Ventures the end of the story? Absolutely not. Another case where our friends at AIG, which apparently if you sell lots of policies, you get involved in lots of these cases, Universal American. So what do they say? Universal American is a situation in which medical providers allegedly were inputting fraudulent claim information into their systems. And so Universal American went to their crime insurance carrier, AIG, National Union, and said, we would like coverage. And AIG said, please take a long walk off a short pier. Different result this time. AIG wins. But in the process of winning, it comes about that there's a discussion. And they're talking about what is actually covered. Well, there is loss resulting from a fraudulent change of electronic data or computer program within the computer system. What do hackers do in a breach? And when there's property transferred, paid, or delivered, or an unauthorized or fictitious account to be debited or credited. So that's what the coverage was for. What happens in a data breach? Think about that. Think about what I just told you. And the court said, based on what AIG explained, this indicates that coverage is for an unauthorized entry into the system. Think about that. What does a hacker do, particularly in a retailer data breach? They insert malware into your system, an unauthorized entry into the system. That is, by an unauthorized user. Wait for it, such as a hacker. Okay? Or for unauthorized data, such as, for example, a computer virus. And that gets affirmed by the Court of Appeals in New York, perhaps one might say not exactly known as a jurisdiction friendly to insureds, but they say again, the computer system's fraud rider covering loss from a fraudulent entry of electronic data or change of electronic data within the insured's proprietary computer system was intended to apply to wrongful acts and manipulation of the computer system, that is, by hackers. So as we're on this panel and we're wondering, is it appropriate to go to your crime insurance carrier when a hacker gets into your system and everyone tells me, well, that's not what the intent was, put an exclusion in the policy? Because you might also look at the Morgan Stanley versus Chubb case.
Scott, I'm going to cut you off here.
I know. I'm going to take over the entire show here. I get very excited.
You'll take the whole hour.
Couldn't this all have been avoided by buying a cyber policy?
If you have a cyber insurance policy and the carrier pays, and they pay for things like the fraudulent charges and the card replacement costs after a retailer breach, then yes, you're done. Because an insured is not looking to double recover. If you've got one policy that covers, then absolutely. But if you go to your cyber carrier and they decide that that's not what they intended to carry, you've got to look more broadly. And if you didn't buy cyber insurance and you go to your broker or to your policyholder attorney and say, what do I do? And they say, well, there's all this case law out there. Maybe you should try and make a run at it there. Absolutely.
I mean,
Well,
Nick, if you want to let him talk about the Chubb case, that's fine.
I normally would, but since we're restricted to an hour, Scott, I think makes the point well that there's some case law out there that goes contrary to what we might think is the intent, and with the amount of confusion that automatically exists, the case law just adds to the confusion. So I think that's a great point. Let's take a step back. John, real quick, could you give us a quick overview of what a cyber policy is supposed to do?
Supposed to cover all that stuff that Scott was talking about, so go ahead. Putting my broker hat on. Yeah, to me, sorry. A cyber policy is, I guess the best way to probably talk about it is to give an example, and we'll talk about, say, a breach, something very simple, not even to do with hackers or anything like that, but if a criminal breaks into a medical office and steals a laptop, walks out with it, intending totally to just sell that laptop as a piece of hardware, and they have a cyber policy in place and they have a crime policy in place, the direct loss of that laptop, the value of that hardware, should be covered under a crime policy. There's no computer fraud or funds transfer issues here because it's just a laptop. But after doing a little bit of forensics, key forensics on the cyber liability side or the cyber policy side, it's discovered that on that laptop there was a batch download of every patient that's ever visited X medical clinic, and there's 450,000 records on there or something along those lines. The crime policy, if I'm not mistaken, is not going to cover the value or not going to cover that data that's on that laptop. So that's where a cyber policy would jump in, suddenly get all of the experts in place to do forensics, to notify those individuals, to provide the necessary monitoring, to defend in the event that after notifying there's a suit or some sort of claim filed against them. That's where the cyber policy comes in. So it's essentially the difference between the direct loss of tangible goods and the indirect loss of something that's intangible, in this case, the data. Is that short enough?
Okay, that was perfect. So the cyber policy is basically designed for things like notification cost, legal liability for the loss, theft, unauthorized disclosure of the information on the laptop in your example.
It's a service. The services are a huge part of the cyber policies that you don't get in a crime policy. Someone's not going to come up in the crime policy and provide a stable of experts that are going to be able to help you mitigate this and tidy it up much quicker than you would if you were on your own. If you had a no cyber policy, just a crime policy, you don't get access to that sort of service.
Okay. Now, Bob, ISO has a series of cyber liability forms. Do you agree with what John's articulated?
I do. I generally think that in the ISO cyber program, we actually have 3 different types of forms. We have one for the mercantile entities, which we call the Internet Security Protection Policy, and we have a comparable version for financial institutions, and then we also have a form that deals with media. But in a sense, from the ISO perspective, that the platform or the forms that ISO offers in the cyber insurance field, we would consider that at ISO to be a standard program like any other ISO program would, like a GL program or a commercial property program or a crime program. So from that perspective, let's consider this to be the standardized program for the cyber insurance market. But yes, I do agree with the statements that were made.
Okay. And the Insurance Services Office, ISO, also offers a number of crime insurance forms.
Yeah, it does. And before I get too much further into that, I have to start off, by saying, actually didn't start off by saying this, is that anything that I do say is purely my own perspective and not that of ISO's or any of the insurers that might use the ISO products. But yes, in the crime world, we offer quite a few different products. Most of it's driven because of the way that crime insurance is delivered, whether it's a package policy, which are for smaller insurers, or for the monoline crime policies. So we do it that way. And then, of course, within the crime world, there's the menu of coverages, whether it's an employee theft coverage or a theft of money and securities coverage. In considering this whole spectrum and this whole idea of what cyber exposure is in the insurance marketplace, we had been working on changes to the ISO crime program for cyber before DSW, Retail Ventures, hit. We were actually looking at changing and revising the computer coverages because of other types of court decisions that were coming in, construing coverage under computer fraud because of a fraudulent email instruction or something like that. So we were already in the process of revising that product and also to change the coverage and modernize it and tune it up. We were getting away from the idea that the property had to be inside a physical premises and then transferred outside that premises for it to be a computer fraud. So we got rid of this notion that you had to have this physical barrier before the coverage would apply. So, we tuned it up that way, and we did a lot of changes. And then when, the Retail Ventures decision came down, that changed the ballgame entirely.
Okay, let me redirect you a little bit here. Let's start with just real quick. Can you give us an overview of what the ISO crime forms are designed to do? And then we can talk a little bit about how they're changing as a result of some court decisions.
Sure. They're really designed for the losses that the insured sustains that are physical type losses of money, securities, or other property. They're not designed for covering the intangible issues, expenses that may relate to a loss itself. Those would be considered an indirect type of loss. So the types of expenses that you would incur from a data breach really would not, and I don't think anybody would intentionally expect that to be paid or a covered type of a loss under a crime policy. And so it's really more the tangible type property covered under crime versus the intangible nature and aspect of losses, which are really more appropriate for coverage under the cyber products.
Okay. And how are the policy forms changing? What are you doing in response to some of these court decisions?
Well, in response to these court decisions, particularly with response to the Retail Ventures decision, we went back, and it actually was it was a huge ripple through the entire crime insurance industry. So we went back and did two things. We already had a confidential information exclusion within the ISO computer and commercial crime policy, and because of the Retail Ventures case, we did two things. We split out the concept of what confidential information was versus personal information of others that the insured may have in its possession. So both of those were excluded within the revised confidential information exclusion. And then we went one step further and introduced a specific data breach exclusion to specifically say that the cost and expenses resulting from a data breach of personally identifiable information was not covered under the crime policy. And then the basis of that exclusion was used, and it was actually the platform that was used later by at ISO for the general liability policy and also the business owner's products.
Okay. Dave, you see a lot of products in the market. Is everything you've heard this morning consistent with what you're seeing in the market?
Yeah, pretty much. And I think John's point about it being the cyber policy being really about the service that comes with it, and I think that's definitely critical. And I was just thinking, to me, it's almost more important to remember, is it a first-party policy or a third-party policy, third-party liability policy, or a combination of the two? And so for cyber liability, to me, that's really a blended two-part policy. There's the credit monitoring, notification, forensics, the stuff you were talking about that comes out of your client's pocket. You know, that's first-party, that's my money going out. And then there's the big liability component. If everything goes wrong and I get sued or I owe to somebody else, you know, that's third party. And then the crime policy, I always look at that and say, well, to me, that's a first party issue. So when you talk about privacy liability, that's something different. If you're getting sued, to me, that's not crime. Crime is for when money is going out of your pocket. And it gets confusing on cyber because you have so many different forms. There is no standard. And it's nice on crime that a lot of the insurers historically have used an ISO form or another form. So then you get used to seeing how things are laid out and have an expectation. People have come out with more proprietary forms to make it confusing. But
we do that on purpose, by the way. Chris and I get together and make confusing forms.
That keeps us busy as brokers.
Yeah, to keep you busy.
But on the crime forms, I'm always thinking about kind of the three W's, the who, what, and where. Because you always have to look back. Like Scott will say it's not excluded. And I think if somebody sold a policy guaranteeing the number of peanuts in like a peanut butter, he'd find a way to cover cyber on it because he's very good at what he does. And so even though something's not excluded, I still look back to what are we trying to cover on this policy? And it's theft of funds or money or other property. And that other property, I don't know if it's ever specifically said, we're talking about records. I've never seen that on a crime policy. But since it's not excluded, he finds his wiggle room.
Let's not forget, too, that we hear the word intent a lot. And so taking it out of the legal context, a lot of times on the carrier side, intent means our underwriters aren't trained to do this. They don't know how to underwrite to it. Honestly, that's a lot of times what I hear when I hear intent was on the crime side, they may not be thinking about this risk. So computer fraud and funds transfer coverage, I think became a bit of a throw-in after a while. And that's the sort of thing coming from the the side of a cyber underwriter, and Chris will most likely agree with me on this, you don't just throw in a cyber sort of coverage, because if you're throwing in that level of computer fraud, funds transfer coverage, that to me is you have to have that underwriter engage in a full-blown underwrite of that company's system. That's a cyber underwrite along with crime, and I don't think for quite a while that was happening.
Well, Dave, let me ask you to that point. Are you seeing, to confuse the matter farther, are you seeing cyber crime endorsements being added to cyber policies?
Well, I've seen some forms that'll give an element of crime coverage where it might be a sublimit for an amount of theft of funds. I am seeing now, more recently, the cyber liability, everybody's trying to add it to everything. I think because it's so hard to sell, if you can lump it in somewhere, you'll end up selling it without as much effort. So there are a number of carriers now that are putting cyber enhancements on crime policies as opposed to the other way around, which to me is confusing because going back to crime insurance, it's first party, and now you're throwing a third party cyber liability component to it.
Okay.
Yeah, I was just going to say we see competitors' forms, and just because you take two policies and you staple them together doesn't mean that you have a crime policy with cyber coverage or vice versa. So we see a lot of bolt-on and combined form type coverages that don't necessarily fully contemplate or intend to cover both aspects or all of the aspects included in that coverage.
Okay.
Yeah, and from the ISO perspective, I would also say that what we see out there is we do see a trend, or at least a perceived trend, of adding more of the computer fraud covers, the traditional crime coverages, into the cyber products, for sure.
Okay. So what I've heard in general is that cyber policies are generally designed to cover legal liabilities arising out of the loss of intangible property, as well as things like notification costs and the services. Crime policies, more of a first-party coverage designed for things like money, securities, and tangible property. Let's look at some actual scenarios now. If I could ask Tom to bring up our first slide. And our first scenario is going to be a mortgage company that is seeking coverage for the hacking of a computer system by an outside third party, causing a breach of consumer financial information. The mortgage company wants coverage for class action claims made against them that might result from such a breach. Gentlemen, anyone have an opinion on what would be appropriate in this case?
I think I speak for both John and myself in that it depends.
It depends. Would you elaborate, please?
Sure. So when we speak, and certainly the brokers and underwriters and insureds all know that we speak in hypothetical claim situations, partly because the coverage is new and partly because there aren't as many claims out there to have real, true, tangible examples. So you get asked these hypothetical situations, and joking aside, it does a lot depend on particular details for which Scott then exploits in order to get coverage. But what I would say in this particular situation, in its most simplistic manner, you would want first and third party cyber coverage, probably a banker's professional liability policy, and a director's and officer's policy, just to make sure you have all of your bases covered.
Okay. Well, given the scenario that they're looking for coverage for third party claims being made against them, touch on why you're recommending first-party cyber coverage and what that means.
Sure. No, that's a great question. So I said be banker's professional because you're selling mortgages, and there is some probably more overlap between a traditional E&O policy and a cyber third-party liability policy, so long as the issue arises out of your goods and services. But the first-party component is important in essence that it gives you the resources and the ability to respond properly to a breach, which will then minimize the impact of the third-party issue. So when your class action claim comes in and the customers say, we've been harmed, and the insured can then point to all of the insurance services that they've provided, all of the professional consulting that they've gotten in order to respond to the breach properly and hope to minimize the damage to their customers who are then going to try to bring suit in the future.
Okay, so by first-party coverage, you mean coverage for things like notification expenses, credit monitoring, maybe computer forensics to investigate the incident?
And the crisis management firms, which will essentially walk you through what you need to do in the event of a breach.
Okay. Anybody else have any comments on this scenario and what types of coverage you would recommend?
I think Chris covered a lot of ground on that. And I was thinking also ask your insurance agent how much limit they have on their E&O. Because I know when I looked at that, I thought, oh, this is obvious. It says breach, so you're talking about cyber liability. And then he brings up other coverage, and you know what? That's totally true, too. So,
For D&O, definitely. I mean, if you can allege some level of negligence, and who knows, this might be a public company. I mean, I think Chris is right that you have to think beyond just. I mean, to me, it says cyber. It's for a breach liability. It's kind of leading into it, but there are other areas that could get tapped into, and you've got to definitely make sure that you have those covered. Not to bring up Target because we talk about it all the time. It's like Target. I just want to jump off a cliff. Sorry about that with Target, but there's been multiple derivative suits, class action suits. They're going after Target. That entire insurance program is at some sort of risk because of the size of this. So I think it's a good example that it's not just cyber. There are other coverages. But what I don't see in this is, in this particular scenario, crime. It's liability. And there is no, last time I checked, coverage for liability or defense and settlement under a crime policy in this scenario.
and since you mentioned Target, we probably have to add in employment practices for the wrongful termination of the executives.
Perhaps.
Alleged wrongful termination.
Let's move on to scenario number 2.
Oh, sorry. Yes, we will.
Thank you.
Clapper.
Okay, a retailer is seeking coverage for the hacking of computer systems by an outside third party causing a breach of credit card data. I think someone just mentioned Target. The retailer wants coverage for PCI fines and penalties, as well as other damages that they may be legally liable to pay under a merchant services agreement.
I take this one.
Absolutely. Go ahead.
So, take Target. It's a good example. I don't think any one of us at the table, or maybe I'm wrong about that, are working on that right now. They'll be in the spot where after the credit card data, again, you all went to the PCI, or some of you went to the PCI session. You know that the brands are going to either directly or through the processor say, we're taking the following amount of money because it's for fraudulent charges and card replacement costs, and we're also going to fine or penalize you as a result of your non-compliance because whichever PFI came in is going to say that you were non-PCI compliant, because that happens in every single incident involving this. And so you turn to your cyber policy first. I mean, that's the easiest one. That's the one that they'll tell you what this was designed for. Then the big question is there going to be cover? Are they going to fight you? Is there going to be a sublimit or something else? And if there is, then you pull out the retail ventures case and you look at your crime insurance policy. And is there a computer fraud and funds transfer fraud endorsement in there? And figure out, is there cover elsewhere? I mean, the easiest thing for an insured and for counsel to insureds in a situation involving cyber, which one of my friends at Zurich mentioned is more like a peril than something else, is you look to the cyber policy and say, okay, I hope that everything's covered here because that's how it was marketed, as peace of mind for a cyber peril. But if the cyber carrier decides, or someone that they're working with decides this is not what we meant to cover, you've got to look elsewhere. You've got potentially millions of dollars in uncovered risk if the situation is that we're not covering this, or that there's a sublimit or something else, that there's not sufficient coverage available. And then you figure out, is there an opportunity to look at the language and say there's not an exclusion, and in light of the case law, that there's a pretty good argument here.
I would say, but for the fines and penalties, though, I mean, that is something that is broadly excluded outside of the cyber world. And that would be, I think, a difficult thing to find.
For something that's called a pure fine, it's unclear under retail ventures exactly what the $4 million encompassed, but it did encompass the amounts that Visa and MasterCard sought as, at least as assessments. And perhaps they didn't drill down into separating things out to saying we're going to call this amount for fine and penalty to be an uncoverable loss as a fine or a penalty. And quite whether, as a suggestion has been, that that's an uninsurable loss. But ultimately, if you're familiar with that sort of thing, if you're in the spot where you're comparing fines and penalties versus assessments, or however you want to frame it, if they say you weren't PCI compliant, so we're asking this much, that's $100,000 or less in a lot of these. I mean, I'm not sure how much it will be for Target, but for other big retailers with multi-million numbers of credit card numbers lost, the amount that's called a quote-unquote fine for failing to be PCI compliant is small potatoes compared to the assessments for fraudulent charges and card replacement costs. And so I think if a policyholder was trying to make a trade-off of I'm going to go after this carrier, or I'm going to seek coverage under this policy for the amounts that the brands are seeking from me, either directly or indirectly from a processor, then they probably would not happily, because I don't have it in my pocket, but take a trade-off of not getting $50,000 of coverage but getting $6 million in coverage for some losses.
And I think there are so many different PCI endorsements out there too, and they're not all identical. You have to pay attention to what they say about fines, penalties, and assessments. But then a feature I like that I've talked to Nick about in prior years too is let's get some help for these smaller merchants or restaurant, whatever, that's going to be assessed. Let's provide an attorney or a certain amount of money for an attorney to fight that fine instead of just having money lifted out of their pocket, an arbitrary number or whatever. Not everybody has a feature like that in their policy, but having that ability to push back with some help is a good thing too.
Well, I don't want to repeat the PCI panel, but there certainly are a lot of important coverage ramifications when you get into PCI. But I'm sensing agreement with what Scott said in that the cyber policy is the place to start. I'm not sure there's complete agreement that the next place to go is the crime policy, but one of the things that I understand, talking about DSW or Retail Ventures a little bit, is that policy was not written on a standard policy form. I don't know if anybody from the panel has any comments that they can add to that. No, unfortunately not. So, I do think that that's a difficulty in this space, and that there are a lot of manuscript policy forms out there in both the cyber portion, as well as there may be non-standard crime forms that can result in decisions that might be confusing to people. Let's jump over to scenario number 3. And scenario number 3 is a manufacturer of widgets. We've all gone back to school. Learned that a rival widget manufacturer incurred a large loss after an employee of the entity was the victim of a phishing attack. That certainly sounds cyber-related. An outside third party obtained the user ID and password for that entity's banking account and then used the credentials to transfer a large amount of money to an overseas account. Now, this manufacturer wants insurance coverage for this type of event. It sounds cyber-related. We've got a phishing attack. We've got things happening on the computer. What do you guys think? Is this a crime coverage? Is the best place to go for this crime coverage? Should you buy that, or should you buy a cyber policy? This is your concern.
I think on this one I'd be looking at the crime right away, because you're talking about money going from a bank account, and the crime policies all talk about theft of money or securities from your premises or your bank. And so here I see that money going out. And then there's obviously a whole cascade of events that could happen after that are a big problem. But to me, that's screaming crime.
There's part
Scott,
of it, though, that's...
I'm sorry.
Sorry, go ahead, Scott.
Go ahead, John.
Well, part of it to me says that that this is a phishing attack at another entity. So we're also going to include that other entity. And this to me is where the not talked about portion of cyber policies, network security liability, I think we'll all generally understand what that is, would provide there'd be some sort of trigger in there for the theft of those user credentials used to gain access to a third party's computer systems. And then after that, I think, is where you see the crime pop in. But so there's for this scenario, there's two parties involved here. One might be better served to have a cyber policy in place so they can access that trigger point, that network security liability. And then when the funds are actually transferred, you have that party number 2. So here I'm selling, 4 policies, 2 to each side. So.
Well, you've twisted the scenario just a little bit. I think the
It's
intent
early.
here was that the manufacturer's system was being hacked into, or the manufacturer's employee was the victim of the phishing attack. Unless you're suggesting that the bank might have legal liability here?
That's a tough one. I've had this discussion multiple times, and if the bank would have any actual legal liability, it's difficult because the bank, in a way, had nothing to do with it. The bank systems recognize those credentials as being perfectly fine. The small banks, community banks, they have these issues all the time. I hear a lot about these computer account takeovers. So someone at home has a phishing attack. They don't know any better. They get key logging software onto their actual home computer. They access their bank account. Money gets taken. The bank doesn't know that these user credentials are fine according to the bank. They lose that money. They might try to go and get it, but that's a write-off. I think a lot of times the banks have. As far as legal liability, I'm not sure. I don't see much of a connection there. Anyone? Scott, you agree? Disagree? Do I get to agree twice in the same day with us?
I do agree on two levels. In terms of the banks, there's only the one case out there, the Heartland Payments case out of the Fifth Circuit, which talks about who can be chased and the economic loss doctrine, something that some might argue is an evolving doctrine. But then in terms of where to go, I agree with the thoughts as to, for the manufacturer, when their system, when basically money is transferred out as to an improper input of information electronically. If you look at that Universal American Corp case, that's what the court said it's about. And then the Chubb case involving Morgan Stanley, same thing. They said basically if there's fraudulent entry of data, particularly by third parties, that's what the policy is designed to cover when there has a computer systems fraud endorsement in it. And as to cyber policy, I certainly would pick it up and take a look at it. I mean, there have been multiple comments here where they're not all written on common forms. There are intricacies that allow underwriters to market them as offering special coverage, better coverage, different coverage from others. Take a look there. But so I would start with both and say to the client, if you haven't already noticed it, let's take a look at both policies and figure out what's in there. And if you've got the endorsement in the crime policy, that's a great place to start. And if you've got a cyber policy that will cover this series of events, let's take a look and see what's in there, work through it, and figure out if we can put them on notice, because there's a good analysis of and a real reason to make a claim.
I think that's an interesting point, too, because there are crime policies that have a forensic component where they'll help you investigate, and that's not going to be cheap either. It's not always as cut and dry, where this employee screwed up or whatever. Somebody had to figure out how that phishing attack got in. So if your crime policy didn't have that forensic coverage, then I think that is a great idea to go to your cyber policy. Although you don't have somebody suing and it's not necessarily liability, it could lead to that situation. So why wouldn't you try to take advantage of that situation? And maybe you say, I wouldn't cover
Dave,
that.
are you suggesting that the employee was not the victim of a phishing attack and actually gave his credentials to his girlfriend? And that's how the theft occurred?
Well, that could happen.
All right.
I'll actually
Chris.
also agree with Scott on 2 points. One is that there are
It's a banner day for me today.
I know. There are many insurance policies involved in this particular situation. The manufacturers, possibly the bank's fidelity policy, if it could be argued that they got fraudulent instructions to transfer the money out. And then 2, on the second point, is that you're going to want a good legal team, right? Because your consumer bank account is protected by federal regulation against fraudulent charges. So if you report to your bank that you have fraudulent charges on your account, they're required to reimburse you. Commercial bank account customers don't have that same protection. So there have been a number of cases where this has happened. A commercial company has had their bank account taken over, money withdrawn from their bank. They then turn to their bank and say, hey, we didn't actually want to do this. And the bank says, not my problem, or something along those lines. So then they sue. And there have been a number of cases, I think, coming down on both sides, some on the favor of the companies, saying the bank should have done more to protect against the fraudulent withdrawal, some on the case of the banks, saying it's the company's responsibility to keep your credentials confidential and keep control of your bank account. So this is probably the most complex of the cybercrime issues and the crux of what we're trying to get to today.
Let me ask this. What about, in the last session, somebody brought up Bitcoin. If we're talking about something like Bitcoin, what sort of special issues come up if it was a theft of Bitcoins?
Bitcoin is either currency or property. I mean, but actually, if I'm not mistaken, the U.S. government, the IRS considers Bitcoin property, not necessarily. They don't consider it currency. So we have that issue.
It is also data.
It's data. It's an algorithm. It's code. It's IP.
Basic form, right?
So I mean, Bitcoin is interesting. I think it's such a new phenomenon. It's been around for a while, but it's getting more news lately. But I'm not sure where a policy would go in respects to Bitcoin. I think right now it's not considered by most governmental authorities as a currency. Therefore, you could have a hard time going to a crime policy and arguing that it's a transfer or loss of funds. Somebody might say it's not funds. The U.S. government says it's something else, or it's not anything at all.
Let's drill down a little bit. Is Bitcoin going to meet the definition of currency under most crime forms, generally?
I think that's a hard one to answer. I think you're right in terms of a financial institution product. It has to be money that's recognized by a government. I don't know that Bitcoin is actually recognized, or any type of virtual currency is recognized by a government at this point. And so when you look at the definition of property or money in the crime policy, it's not so clear, because the definition of money in the crime policy just talks about currency, coins, notes, et cetera, et cetera, et cetera. From the industry's perspective, and this is actually, from ISO's perspective, an emerging issue, and ISO is actually looking at this whole issue of virtual currency and how, it relates to the issues and the coverages of the crime policy. There's a lot of division, I can tell you, within the industry on whether or not these things would be covered and how. And then not only is it just an issue of is it money, or is it a security, or is it a property as the IRS says it, it's also an issue of how do you value it at the time of loss.
Okay, so if I hear what you're saying, it's not clear that it's money, securities, or tangible property. Scott, let me pick on you. Would you agree that if somebody wants coverage for Bitcoin, they should specifically have that written into their policies?
That's a best practice. I mean, that one's an easy one for me to agree with Nick on.
It's a holy grail. I got Scott to agree on like 4 things this morning.
The easiest thing is if there's something that's written into the policy that says we're going to cover this, great, then that means you don't have to call me. In theory, that you turn to your claims person and you say, look at page 74, there's an endorsement for Bitcoin. If there's not, and then you have a question about whether is it money or property, and there's a discussion about how there's lack of clarity, that's when the insured is supposed to, the tie goes to the runner, the tide goes to the insured in terms of lack of clarity is supposed to mean that there's coverage for something, particularly if it's in terms of an exclusion. But as to is it money, if money is not a defined term, you certainly could argue about, well, is it money or is it just some wacky concept by gamers and computer hackers and the like? But if it's something that's used as a value for somebody else, I think you've got a pretty good argument it's money. You turn to a dictionary definition, which is the fun part of a coverage dispute. You get to see, is that what it meant? And if you hear arguments like, we didn't intend to cover it, say, well, okay, well, what did you intend to cover and why is it not excluded? If you, again, you're in the basics of the policy and there's a crime and everything else is triggered and you're arguing about whether it's money or if it's property or it's something else, you've got a pretty good argument as the insured's counsel and as the insured to say, we're in pretty good shape here. Because to argue that something is worth millions of dollars to a company and then for the insurance company to say, but it's not quote-unquote money, I think that would be a pretty good argument that I would like to be able to make to the court to say, everyone's calling this money, this is in every single news story, and it's so what, it's not on a U.S. dollar format. We consider it to have value, and insurance company saying it's not money as an undefined term, I think I've got a pretty decent chance of getting that covered.
To me, there's a parallel with casino chips because it's sort of a make-believe money, and you can get something like that covered on a crime policy. Otherwise, you'd be arguing over the value of the clay that went into the chip and what that value is, as opposed to what's printed on there. So I think you can get it addressed. And then I was just thinking about, too, where's it stolen from? And Bob may be able to say better about the specifics of where it's stolen, but you think about money stolen from your premises or a banking institution, and is a Bitcoin something that's held by an exchange in cyberspace, not a financial institution? Would that not be addressed in a crime form?
Okay. In the interest of time, I'm going to move things along to scenario 4 real quick. Now, scenario 4 is an inventory management systems are becoming increasingly sophisticated. An electronics manufacturer is concerned about a hacker being able to hack into the entity systems and redirecting shipments or otherwise having inventory shipped to fraudulent locations.
I had looked at that, and again, from my perspective,
I want to go near the.
I had looked at that, and again, from my perspective, the computer fraud coverage of the commercial crime policy does, cover fraudulent transfers of other property, just like it would cause a fraudulent, cover a fraudulent transfer of money. So I was looking at it, and I wasn't sure, was there something else within that scenario that I was missing?
In the
Chris?
purpose of perpetuating the ambiguity, you could make an argument that there would be network interruption coverage in here. If business can't continue because you don't have inventory because it was wrongfully shipped due to a cyber attack, that sounds interesting to me.
Can you
And
speak up?
So you're suggesting
You're-
that it could
you're
be
welcome.
a loss of income due to the loss of the computer systems? Is that it?
well, it would be a cyber attack against the computer system that causes your inventory to get shipped. If your business is not able to operate without that inventory, depending on the particulars of your policy, that could be a covered matter.
Chris, have you met Scott?
That's why I said you're welcome.
You guys may want to.
You guys are helping me out. It's great.
Okay, so I think generally speaking, although this scenario is a little bit different than a theft of money, it's really focused on tangible property and the value of that tangible property, something a crime form's designed for.
Yeah, and the network interruption is not going to cover the value of those goods. It's going to be your lost future revenue because your business is not able to operate. So, some clarification.
Let's take a pause for a minute. I want to see if there are any questions in the audience. If there are, we'll go ahead and tackle them. If they're not, I've brought a bonus scenario. Oh, I see a question in the back.
And over here, too.
Okay, and over here. Thank you.
Sorry, the mic's missing back there.
Do we have a question back there? Okay.
Yeah, on the one of the scenarios you had, there was actually a conference a couple weeks ago where a U.S. attorney from New Jersey was saying they had a entity that got a spear phishing attack that said it was purportedly from the CFO to make 3 payments of $1 million to, I assume, one of their suppliers. They made the first payment. They made the second payment. Somebody raised the red flag, so they didn't make the third. And the U.S. attorney said they thought they were going to get the first $1 million back, or the second $1 million back, but that first $1 million was probably gone. And the way you were saying it, Dave, you would just look at that straight as, hey, that's money out the door. It's the crime policy, even though it was a spear phishing attack. Would that be straight? You're just going to look at the crime policy, or in some way, say if you don't have the limit, say they lost $2 million and they only have a million limit. Can you look somewhere else for that?
Yeah, I mean, now that we've spoken for an hour about fidelity policies, are there any underwriters or brokers with specific fidelity background? No? Okay. Okay, so then we're the experts then, so we'll take it from there.
I think we're going to suggest that the appropriate coverage there is a crime coverage because it's really a loss of money.
Yeah.
Very similar to the
Yeah,
scenario that we
ask your broker and your carriers about the fake presidents is I think that how that's addressed, and your policy might require some adjustment to make sure that that's 100% covered.
I think you struggle too because I can't remember if you said there was an extortion component that they were trying to make something go away, or
So
Yeah,
if I
the-
understand correctly, the spear phishing attack enabled the hackers to get the banking credentials.
No. It's
Oh, I'm sorry.
it's a phone call. So I call the Treasury Department of Target, since we're picking on, and I say, we're doing a super secret deal. I need you to transfer money into this account. They do it because I'm the CFO, and then it later turns out that it was all nonsense and that money's gotten transferred out because I spear phished them in the old traditional non-computer social engineering sense.
Okay, Bob, any thoughts on that one from the ISO perspective?
Well, typically, under the funds transfer coverage of the crime policy, you would pick up, the instructions of an imposter, whether it's a telephone call or a computer-generated instruction or anything else. So within the fact scenario presented, you probably look for coverage there.
Okay. I
think that kind of relates to my question. Isn't there a false pretenses element to a fidelity policy where you're getting legitimate instructions if you're the banking institution, but it's not the right person giving them? So isn't that, the company that had their bank account stolen from, isn't the reason for that false pretenses, which is really a traditional fidelity matter.
Yeah, I mean, we always have these conversations, cyber and crime, and we always end up saying, well, it's the crime policy's problem, and you need to figure out how it's ought to be addressed there. But I mean, I would make the argument sort of along the lines with you that it's a forgery or a fraud, But that's up for your crime underwriter probably to let you know for sure.
Okay. Do we have any other questions in the audience? Seeing none, let's go to our bonus scenario for the last few minutes. A bank is concerned about its exposure to loss from prepaid debit cards. And specifically, they've heard of a situation where another bank's computer systems were hacked into. The hackers were able to remove the limits from a number of prepaid credit cards. Gangs affiliated with the hackers then used the cards to withdraw cash from ATM machines in various global locations. So this is a complicated scenario, but in essence, the hackers have been able to take the limits off the cards, and the cards are being used to withdraw money from ATMs.
I would start off by saying that typically, particularly on the financial institution bonds, there's a credit card exclusion, which is fairly broad in the sense that it excludes any use of a credit card or the information contained therein. Now, again, it's going to be all related to the fact scenarios here, but I think that would be one area that would certainly need to be examined in this kind of a situation.
Right, and in that
Chris,
vein,
any comments?
In that vein, it's a covered fidelity issue that happens to be excluded under your policy, which no fidelity underwriter wants to hear that.
Okay.
But I'll go back to it depends, right? So it depends on who's trying to get their money back. The individuals whose prepaid cards, they're probably going to get reimbursed from their financial institution because of fraudulent payments. If it's one bank demanding money from another bank, that's a different scenario. If the prepaid debit cards were used at the bank's own network ATMs, that's first-party loss because it's stolen from your own systems. If the ATM machines are on a separate network, as is usually the case, that ATM administrator network is going to then turn to the bank and say, your customers withdrew $10 million over the weekend. I need you to pay me that money. And the bank is going to say, well, no, we don't know anything about that. And then now it's a third-party claim.
Okay, well, let's break that down a little bit.
We could move on from that. That's fine. Too. But you're in charge, so whatever you want.
We've got 3 minutes left, and I fully intend to use them. If the theft is from the bank's own ATM networks, the money is withdrawn from the bank's own ATMs, probably just not a covered claim under crime or cyber. That's what I hear you saying?
Yes, so the fidelity policy excludes because of plastic cards, and the cyber policy excludes because of theft of the insured's own money, which we imagine is covered under the fidelity policy.
Okay, but if the money is stolen from the ATM networks of other banks, and the other banks or the ATM networks come back and make a claim against the first bank, the bank that was hacked into, demanding reimbursement of their funds, you think that might be a claim for damages?
To me, that sounds like a cyber liability third-party claim. But I was just thinking, you can't fully put out a scenario that has every detail, but I was just thinking, is it money that belongs to the customers of the bank, or is it the bank's own money? And like you were just going into, that downstream effect, I have a security problem at my bank, and that's me, and now other people are suing me, and to me, that part coming in sounds like cyber liability.
Yeah, I think that's where we're trying to go here, is that there is a possibility of this being a third-party cyber liability claim. And, you would have to analyze it very carefully against the policy, but, this is where the policies really start to converge and overlap, and where there are some potential issues that really need to be looked at. And this is where it gets into every policy being different, could really make a difference on how this would be covered. So I want to thank the panel this morning for going through this and covering everything. Just to kind of sum up, I think what we've determined is that, at least in terms of intent of coverage, despite whatever cases you may have heard of, in terms of intent of coverage, if it's a loss, theft, unauthorized disclosure of information, and your client's seeking coverage for legal liabilities arising from that, PCI fines and costs, or notification issues, crisis management issues, that's really the purview of the cyber policy. If, on the other hand, they're really looking for coverage for loss of money, securities, tangible property, things like inventory, that's really, generally speaking, the purview of the crime policy, even if it's a cyber-looking event. So, thank you, gentlemen. I appreciate your time. We'll turn it back over to Tom.
Thank you.